Welcome back. As promised, let's get chatting with the management of Latent View Analytics in their, which is the first corporate on the show. The global data analytics project business is projected to grow $403 billion by 2032 from around $65 billion right now. To discuss this, as well as what's the big opportunity in the AI space, we're joined by Mr. Rajan Sethuraman, the CEO at Latent View. Hi, Mr. Rajan. Good morning and good to see you in. Well, first, let's just get a couple of basics out of the way. Accenture, they have flagged some caution, but you were guiding for around 18 to 19% revenue growth with margins at around 23% or thereabouts for FY26. Right. That still holds?
That still holds, yeah. No change to that. In fact, I just got back from a trip to the US, and we have confidence based on the conversations that are currently underway.
All right, so that's good news then. You're sticking to that guidance that you'd given us earlier. Post this trip in the United States, is there a chance that you can outbeat this high teens revenue growth that you were targeting?
I would say it's still early days. I mean, I was hearing a great amount of interest and euphoria about everything AI, GenAI and agentic AI. And many of the people that I talked to, both with big companies as well as smaller startups and services firms, they indicated that there is a tremendous amount of work that needs to be done in order to capitalize on all these opportunities for enterprises and for services firms like us. But given the macroeconomic scenario at this point in time, we still caution in terms of big deals coming through. So I would want to wait for some more time, right, before I'm able to comment on that.
Got it. All right. Now, GenAI is high single digits as a percentage of your revenue, but you have guided that you're going to be doubling this. What kind of interactions are you having with the clientele, and what kind of response have you got? And how confident are you that from around 8-9%, it goes to, say, 16-17% in the coming year? And in fact, post that, takes even a larger chunk of revenues?
Well, the confidence is quite high, and that is all based on confirmed engagements as well as opportunities that we see in the pipeline. Even at the start of the year, we saw that it was going to get to double the number, right, that we did last year. My recent interactions with clients and prospects, again, affirm this conviction that we have. There are multiple engagements where we are now scaling from having executed pilots and POCs into production capabilities. And then there are a whole host of experiments that are being spun off as well, right, by any organization. So in general, the confidence on that number is fairly high.
Okay, Mr. Sethuraman, good morning. Prashant here.
Morning.
Two questions. One, we've been hearing for some time that what's going to happen eventually as a broader, not just for your company, is that this AI thing has now been around for a while. That service providers, like you, would be able to use AI to better your productivity, lower your costs, etc. That's the first phase. The second phase is essentially when your customers will say, well, you're doing it a lot more cheaper. So we want that advantage passed on to us. Is that way of thinking about it correct or not? That is one. And second, how big is agentic AI? People like Eric Schmidt are saying that it's going to really take the dire IT space by storm early next year. It's going to arrive in full force. And what will it do to a business like yours?
Right. No, I think the thinking is absolutely right in the sense that there is going to be a lot of expectation from clients in terms of the productivity benefits being passed on to them. We can very clearly see that in the work that we do. Engagements that used to take, say, 3 to 5 member team, 2 months or 3 months to execute, we are now able to execute with 1 or 2 people, right, in a few weeks, actually. So that's already happening. And when we see that, clients also see that, right, in terms of the execution. You are right that the larger companies, I attended the Databricks Summit in San Francisco a couple of weeks back. They're all investing heavily in building out their platforms and integrating GenAI and agentic AI capabilities into the platform that makes it fairly simple and easy if all enterprise data is on that platform. Now, of course, you still have challenges related to data being across multiple silos. And then, of course, even when you bring in the GenAI and the agentic AI layer to build new apps, to build new reports, dashboards, models, and whatnot, there is still effort that is required, right, in terms of coordinating all of this stuff. The optionality in the system is also increasing significantly with every passing day. So I'm expecting that service providers like us will have to switch gear and then start doing more of AI integration work, just like systems integration work in the past. That's what we are calling it internally, helping clients navigate through the optionality and then help build in the kind of mechanisms that they need for delivering enterprise use cases. The demos and the displays that we saw during even the Databricks Summit were all fantastic, and they're all headed in that direction. So I'm expecting that there will be a lot more of the productivity gains that will start kicking in a couple of.
So, Mr. Sethuraman, since you're acknowledging that yes, indeed, it'll lower costs, and even though I completely acknowledge that it's going to be AI integration at some level, like systems integration. Directionally, over the course of the, say, next 6 to 8 quarters, doesn't it mean lower margins for a business like you? Because clients will want their own share of those productivity gains.
I would say that the margins would not be impacted significantly because we are able to retain some of the productivity gains. Margin should in fact be better if we are able to use the tools and the automation that is available. The question really will be around the volume of business, right? And there, the hypothesis that most of us are working with is that enterprises will continue to hold on to their budget and want to get more done using the AI tools and the productivity benefits that are available rather than cut back on their spending. Of course, we need to see how this pans out. Larger firms will be watching this even closely. For us, given the size that we are at this point in time, based on everything that I'm seeing in the market, we feel fairly confident that over the next 3-year period, the growth rates as well as the margin guidance that we have given will continue to hold.
So 23% roughly for this year, for FY26, EBIT at the EBITDA margin level. Got that. Just a word on the top line. I mean, just to go back to that guidance you've given. Your guidance for this year is about 18 to 19% growth. And eventually you want to scale this up to 25%, right?
Yep.
But at the same time, you also acknowledge that deal closure timelines, especially large deals, they're getting longer and longer. So how does that tie in with your margin guidance? What makes you confident of at least 19% growth this year?
Yeah, the revenue guidance, you mean, right? Yeah, the thing is that some of those engagements and opportunities, we have been in conversation for some time now, and I see some traction on them. So when I talk about longer timelines, it's about new opportunities, new logos that we are trying to break into. There is also evidence where initiatives in the $500,000 range, $500,000, they are still going through. The really big ones, right? Last year, for example, we had a $3.2 million win, right, in one engagement. There are a few conversations of that nature. Those things will take some time, but good thing is that we've been engaging with many of them for quite some time now, and we are expecting that some of them will come to...
The closures will happen.
Yeah.
Yeah, so the discussions are going on for longer, but you're looking at quick closures now with those long engagements.
That's correct.
Therefore, that explains that 19% growth guidance at the top line. Got it. Thank you very much for joining in. Good to get that perspective, and we wish you, quite well for the rest of the year.